On China's stock market, we're joined by Joey Lake. He is the global economist for the Economist Intelligence Unit. Joey, thank you for joining us.
Thank you for having me.
Interesting times, Joey, interesting times. Chinese stock markets appear to be pulling back from the brink a little bit. As we just said, Shanghai Composite closing up 2.4%. On Monday, we saw a rally. Thursday, Friday, the index gaining up 5% last week. Do you think that we're seeing signs of stabilization? Is the wild ride over?
I think it's far too early to tell, and I think that some of the measures that have been put in place by the Communist Party over the past couple of weeks really bode quite negatively for the market in the longer term. And I think it's important here to take the longer term perspective on this, because what's happened over the past month in China has potentially going to have a bigger impact, not just on the Chinese economy, but on the global economy than the Greek exit from the euro or when Janet Yellen raises interest rates here in the US. They've really changed the direction of what we thought they were heading in.
Why do you say that these have been negative? Some people do concur, saying that they've sent more of a panic signal. Is that your opinion?
I would agree. Back in 2013, the Communist Party said that it was going to let the market play a decisive role in the economy. And I think a lot of long-term projections for the health of the economy depended on that. And what's happened over the past month shows us what the party will do when it hits some instability as it's pushing through market-based reforms. And so its tendency, we now think, is going to be to stop and to see if it can, again, pull a lever and try and engineer a lift to the economy.
So you're saying that there was just too much government intervention?
I'm saying that the government intervention over the past month suggests that in the future, when it's pushing through other market-based reforms, if it's liberalization of the exchange rate, if it's opening of the capital account, if it sees instability, it's more likely now, we think, to pause and try and again engineer a smoother landing for the economy.
But on the other hand, this is a market which is the world's second biggest market. About 80% of the transactions are by retail investors, mom and pop investors who are highly leveraged, who've lost a lot of money. Was the government supposed to not do anything to stop it?
I think that's a good question. And I think that the government response really, I think, should be judged more in a political light than an economic light, because the danger to the real economy of the stock market crash is going to be quite limited. The stock market in China accounts for around 30% of GDP. Here in the US and other developed markets, it's much higher than 100%. So the fallout for the real economy is going to be quite limited. I think that actually the government is stepping in because it wants to point the finger of blame elsewhere. It took a lot of credit for the success of the stock market over the past few years and the boom. And so now that the market is falling, it's pointing the finger elsewhere.